Hey guys, Joel Frank here, market analyst for YouTrading. In today's video, we're going to be taking a quick look across markets and talking about some of the themes that are going to be in play this week. Pretty quiet start to the week, unsurprising really. Your US markets shut, UK markets shut for a bank holiday. European markets are open, so there's a little bit of liquidity still happening, but usually when you get these market closures in important markets like the UK and the US, you don't get too much volatility. You can see here the DXY going sideways, close to recent highs in the low 104s. Very much looks like this uptrend remains in play. Very much looks like a test of resistance in this. Get that out of the way. In this upper sort of 105 to 106 area where the 200-day moving average meets these highs from 2023. A test of that area still looks likely. I mean, we've had this convincing breakout above all of these major moving averages. Why have we been seeing this push higher? Well, the US economic data, particularly regarding the labor market, regarding the services sector, and regarding inflation, has all been coming in stronger or hotter than expected, which is leading markets to be pricing back in more interest rate hikes from the Fed now and pricing out interest rate cuts from the Fed towards the end of this year. So it's a fundamentally driven rally, but the technicals are looking pretty nice as well, you've got to say. And I think this is probably going to continue because what do we have this week? Obviously, a quiet Monday, but then we've got a lot of US jobs data coming out and US ISM manufacturing. The ISM services is actually next week, but we've got the ISM manufacturing data this week. Now, basically, the jobs data, look at this, the headline non-farm employment change expected to come in at 191. A little bit weaker than last month, that would be, but nearly 200,000 jobs added in May. That's a good rate of job gains. And if the unemployment rate rises only slightly to 3.5%, that's still close to historic lows. So this week's data very much expected to show that the US labor market remains not at its hottest, but still strong, which kind of pushes back against the Fed's push to try and get inflation under control. Because if you remember, let's just go back to last week. We had the core PCE price index data come in a little bit hotter than expected. You don't want 0.4% month over month for the core PCE. If you're talking about trying to get inflation back to 2%, you want this at around 0.1, 0.2% month over month. So the stronger labour market keeping inflation hot. That's probably going to be the message we get from the data this week. JOLTS job openings have been weakening though. I mean, that could present some downside risk to the dollar. This is a sign of fading demand for jobs, which could be a lead indicator for weakening of the jobs market at a later date. But I mean, 9.41 million, if it drops to 9.41 million, as is what is expected here, still way above the number of unemployed people in the US. So demand still outstripping supply by a wide margin, even if that margin is less. And then this ISM manufacturing PMI will show that the manufacturing sector remains weak, but we kind of know that at this point. And then we'll be keeping an eye on various Fed speakers as well, like Harker speaking Wednesday, Thursday, and a few other smattered throughout the week. But yeah, pretty much the uptrend in the dollar could continue. The uptrend in yields, for all of the same reasons, could continue. We had the breakout of the multi-week range recently in the 2-year and in the 10-year. Still a way off the highs that we had before the debt crisis. And it remains to be seen whether we can quite get back to those highs. Probably can. If you're just talking about technicals, it looks like we could get back here. Regarding stocks, also doing pretty well. There's been optimism about Biden and McCarthy reaching a deal on the debt ceiling, which now obviously needs to get through Congress. But the chances of a debt deal being done are rising basically at the moment because they've only got about a week of funds left in the US Treasury before an accidental default might happen. But yeah, like I said, we've had positive news about that over the weekend of a deal being reached. So stocks seemingly liking that, and obviously stocks liking the better than expected US economy, even though that does mean a slightly more hawkish Fed. And then, tech has been getting pumped recently by all this AI optimism as well. Like we had this melt up last Friday of nearly 3% in the NASDAQ 100, which was partially pumped by Nvidia's. What did Nvidia gain? NVDA. Let's have a look. It was like 30%. Let's see if we can get that to load. Apologies for the slow internet here, guys. There we go. Yeah, we pumped last Friday 24%. No, last Thursday, sorry, 24%. And then, we were up another 2.5% on Friday. And that was because of their strong earnings outlook, which was driven, they're expecting massive demand for their chips as these AI services like ChatGPT and competitors explode, basically. They're going to require powerful chips at these databases that power those services. So, yeah, AI optimism also propping up the market. Let's have a look at a few other asset classes like gold continues to trend lower. That's unsurprising when you look at the dollar and yields. Bitcoin pumped a little bit on the debt ceiling deal, but still below recent highs. Not the best environment for Bitcoin right now, to be honest, with Fed tightening being repriced back in, the dollar gaining, yields gaining. But it's the Bitcoin bulls will be happy at what they're seeing. The uptrend for the year seems to remain pretty healthy, even if we are experiencing a bit of a short-term setback. Although, finding resistance here maybe not the best thing. Does maybe confirm and rejecting the 50-day moving average that we're still in a short-term downtrend. Um, what else is there to look at? Quick look at oil. What's oil saying this morning? If it's ever going to load. Again, apologies for the slow internet this morning. Well, anyway, in terms of the calendar, what else are we looking out for this week that could be of interest? Well, if you're a G10 currency trader, like trading the Aussie, you want to be keeping an eye on RBA Governor Lowe speaking on in the early hours of the Wednesday session, and then you got Aussie CPI, you got Chinese PMI numbers coming out for manufacturing sector, which obviously can affect the Aussie as well, but can affect broader market sentiment too. Then we're getting these preliminary inflation readings out of the Eurozone, which are always informative. Like we get the first Spanish ones tomorrow, then we get the German ones on Wednesday, then we get the Eurozone aggregate ones on Thursday. That's always very, very important for the ECB tightening outlook. Inflation remains way too hot in in the Eurozone, but at least it's moving in the right direction. ECB President Lagarde speaking. And that's about it by the looks of it. Canadian GDP, backwards looking though. Not the most exciting, not the most exciting thing really. But did we get oil to load? Yes, we did. Oil within ranges as well, just kind of in fitting with broader markets. Expect volumes and volatility to pick up tomorrow, guys, as UK and US markets reopen. But yeah, guys, I hope you all found this video informative and enjoyable, and I will see you all in the next one.